Hey, welcome back. This is Lynette. We're working on Accounting 1110 review for final, Chapter 8, Part 2. I've had some coffee. I'm awake. That dreadful section on internal control is done, necessary, and done, and we'll move on to one that's more fun. The topic this time is going to be on petty cash. You know, it's expensive to write a check, and sometimes you just have this small expense you need to get paid, and it's much more efficient to just pay it in cash. And so to deal with small expenditures in an efficient fashion, we use petty cash funds. Petty cash funds still need responsibility. They still need internal controls. So what kind of internal controls do we use for petty cash funds? Well, we give someone a certain amount of money, and then we assign them the responsibility to deal with that amount of money. So it's given to one person, and they're responsible for it. They're supposed to keep it in a safe place, so the asset's safeguarded. When they reimburse someone for an expense, they issue a petty cash ticket or a petty cash receipt. Your author calls it a ticket. And to that they attach the receipt and have the person sign it. So there's proof and documentation. And this person's in charge of keeping track of that fund. A petty cash fund is an impressed fund. And what that means is that it's a certain amount of money given to one person, and it's kept at a certain amount, and it stays at that amount. And it's understood that the person in charge will always have cash that equals that amount, or cash plus receipts where they've reimbursed people that equal the amount of the petty cash. It never gets bigger and it never gets smaller. It's called an impressed fund. The entry to establish a petty cash fund is one of the few times you actually reference a petty cash account. Let's do an example. Let's say we have a petty cash fund we want to set up. And we establish the fund at $100. So we take $100 out of our checking account and put it into a general ledger account called petty cash. And that account will remain on the balance sheet at that amount at $100 indefinitely. And the only time it will change is if it's made bigger or smaller. Otherwise, it sits on the balance sheet under current assets, and it's kept at that amount. And it's understood with petty cash funds that there's a person in charge that has that amount, or that amount plus receipts, or some less amount plus receipts to equal that amount. So you make this journal entry to establish the fund. And you might reference petty cash if you make the fund bigger or smaller, but other than that, you don't reference petty cash again, the account. Now, let's further assume it's time to reimburse it. The person who's in charge of the fund has had it for a while. They've reimbursed some people, and they're low on funds, and it's time to reimburse it. Let me drop some facts for you. So we gave someone our $100, and they put it in a box, and they kept it somewhere safe. And anytime someone had a petty cash expense, they'd bring it to our person, who's called the custodian of the fund, and they'd leave the receipt and take the cash. And during the course of the period, we've had a receipt for postage for $25, supplies for $35, delivery expense for $35. And we have $2 cash left in the box. If you add all of this up, the expenses plus the cash we have on hand, you can see that we have accounted for $97. But the petty cash fund was supposed to be $100. So right away, you can see that the fund's short $3. I made that happen so we'd know what to do with shortages. So let's reimburse the fund. We would write a check Now, how much are we going to write the check for? We'll start with that part of the entry. The fund is a $100 fund, but it already has $2 in it. So we're going to write the check for $98. How much we need to reimburse the fund to bring it back up to its impressed amount. Then we're going to record postage expense. And it matches the receipt for $25. Supplies. Spent $35 on that. Delivery expense. Another $35. And that totals $95. And we know we're going to have a short, so we're going to debit an account called cash, shorten over, expense. When we're over, it's a credit, and when we're short, it's a debit. And it is whatever we need to make this entry balance. And now we come up to the $98 we need. When you add the amount of cash you just wrote the check for to the cash on hand in the box, the petty cash fund is now back up to $100 and it's been reimbursed. So we've looked at the entry to establish the petty cash fund, and we've looked at the entry to reimburse the petty cash fund. Normally, those are the only entries that ever actually hit the petty cash account. From now on, every time you reimburse the fund, the credit will be to cash. So you're just reimbursing it. The only other time that you would make an entry to petty cash is if you wanted to enlarge the fund or reduce the fund permanently. If we wanted to make our petty cash fund be $50 more because we had to reimburse it too often, we'd get another $50 out of the checking account and add it to the petty cash box. Once again, we would reference the petty cash account because we're permanently increasing the size, and then it would show up on the balance sheet from then on at $150. It would be impressed at that amount, and anyone who looked at that would know there's a fund made up of cash or cash and receipts that total $150, and it is a current asset. So there's a quick review of petty cash. Let's end this pencast right here and move on to bank reconciliations. Thanks for joining me.